Okay, folks. Should I ask the question? You know what the question is, right? Have you picked your company yet? I'm not even going to wait for the answer. Right? If you haven't, I'm not even going to nag you. Actually, I'll keep nagging you, but not in the class. Right? But pick a company. I don't know whether you've been reading your emails, but I know some of you have been blocking my emails. I don't care. But if you have been reading your emails, you got a very unpleasant reminder towards the end of last week, right? Which is a week from today is what? Your first quiz. You're saying, what the hell do I do now? There will be a really long email this evening on what to do for the rest of the week. And here's what I'd suggest. Forget about the rest of your classes. Act like this is the only class that matters, and it is the only class that matters. Okay? And put the rest on the back burner for the rest of the semester, hopefully. You know? But I will send you everything you need to know. One thing you will not be able to complain about is that I didn't give you enough stuff to do. Okay? So everything you need to know about the quiz, get in that email. I'll also give you the seating arrangements. You know what I'm talking about? We're not all sitting in this room and taking the quiz. It's completely unpleasant. So I'm going to take some of you and put you in a different room. And the TA is going to proctor you in that room. It's in the first 30 minutes of the class. So at the end of the 30 minutes, you all come back here. So it'll be based alphabetically. And I'll try to make sure everybody does 2 here and 1. So I'm trying to be as fair as I can, because I don't know whether what you think of as good or bad, but everybody will have 1 quiz they take outside. You know? So hang in there. By tonight, you will have more information about the quiz. So let's get down to brass tacks here. We were talking about cash flows, right? We're talking about earnings, and we're talking about adjusting earnings for operating leases and R&D. I sent you a weekly challenge. I usually don't bug you about the weekly challenge, but on this one, I'd like you to actually go and try the weekly challenge, because it's a great way of understanding this process of capital. It's not difficult, but it's tedious. It requires that you work through sequentially. So take the weekly, think of it as a review for your quiz. Take that weekly challenge 3, you already have the solution, see if you can work your way to what I'm trying to do when I capitalize leases and R&D. Any questions though about why we do those things, why we capitalize leases, why we capitalize R&D? Okay. Let's move to the next phase in earnings. Now, when you look at the income statement for a company, there is a reported income, right? Presumably, especially if you're looking at operating income, that income should be only after operating expenses. But let me make this a little messier. Let's assume you have a money-losing company, and at least one person in each group has a money-losing company, and you're thinking about normalizing earnings, which basically is one of the techniques you use when you have money-losing companies. You take the average earnings over the last 5 years, and if it's positive, you replace the earnings today, you know, with those normalized earnings. Analysts do this almost routinely. If you do that, my question is, what are you assuming about the company? And I'm going to list off the possible choices, and you tell me whether this is what you're assuming. First, the loss was unusual and the company has historically made money. So that's one. The second is the problems that caused the loss were temporary and they're now past. It could be a strike, it could be something that caused the loss. The third is the business has not changed in fundamental ways. Fourth, the company has not scaled up. Because remember, you're taking average earnings over 5 years. It's not become bigger or smaller over time, or all of the above. Every one of them seems a little true, right? In fact, the answer is all of the above. What I'm trying to say is when people use normalized earnings, the average earnings across time, you've got to think through, are all of these true? Because if I took GE and I averaged earnings across time, I can get a value that doesn't mean much because the company has shifted. If I take Kraft Heinz, which is I'm hoping to value for tomorrow, because it's in the news, might as well take it up. And I'm always happy to take Warren Buffett head on things like this, especially after he's lost money. Right? But tomorrow if I take Kraft Heinz and I use average earnings, guess what I'm going to find? That the company is massively undervalued, that I should buy the stock. The only problem is their fundamental business is melting down. Nobody wants that crappy ketchup. And I don't mean to show I don't like ketchup, and I've never understood why people buy ketchup or mustard or any of that stuff. Seems like if you have hot sauce, who the hell cares about all this other, you know? If that's happened, then normalizing earnings is not going to give me a value that makes much sense. So today we'll talk about being more flexible. If you have a money-losing company, what do we do about making that negative into a positive? So the answer here is all of the above. You are making all of those assumptions in your normalized earnings, and those assumptions, if they're not true, will give you a valuation that's not justifiable. Finally, today, towards the end of the class, we're going to talk about free cash flow to equity. And the free cash flow to equity is the cash flow left over after you made debt payments. Let's say you're valuing equity in a firm. You've projected out equity for the next 5 years, and you're expecting negative free cash flows to equity for the next 5 years. So basically, your cash flows after your payments are negative, 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 negative. You discount the free cash flows at the value of equity today. What are you implicitly assuming the company will be able to do? My question is, when you do these free cash flows, you do them in a spreadsheet, right? You get minus $1 billion, minus $2 billion. You just put the numbers down, you discount them back. But implicitly, when you have a negative free cash flow at equity, what are you assuming the company is going to be able to? So when I say minus $1 billion free cash flow at equity in year one, what am I assuming the company will be able to do in year one? Go out and raise new equity. Is that a safe assumption? Maybe it is, maybe it isn't, but we do this all the time with young companies. We assume that companies will be able to raise capital to cover those negative free cash flow to equity. And I want to talk about how that might give you too high a value for companies where you're worried about, will I be able to raise capital? So again, it's a hidden assumption. We don't even think about it when we discount the cash flows. But anytime you discount free cash flow to equity back, it's a negative number. You're assuming the company is going to be able to raise capital. So let's go back to the notes because I want to cover, as I said, take each of those items and spend more time on them. So let's take a very, very simple problem. Let's assume you have a firm, and let's say this is a firm you're valuing. It's reporting an operating loss of minus $500 million. But that operating loss is after a one-time charge, an extraordinary charge of $1 billion. If I just stop there and get with that information, I said, when valuing this firm, what would you use as your operating income for last year? The actual number is a minus 500, but that minus 500 exists because you have a $1 billion one-time charge. What would you use as your operating income to value the company? Well, just add the $1 billion back, saying if it's one time and it's gone, why am I even, because everything is about the future, right? And many of you are going to face conditions like this, where you have a company, it reports, it says, our one-time charge of $1 billion, but if you don't count it, it will look like you made a lot of money. Analysts in the late 90s, we were tracking UK companies, concocted a term called EBBS, and it's not what you think it is. It's earnings before bad stuff. And here's how it would work. Companies would say, our earnings before bad stuff was $6 billion, but we had a lot of bad stuff last year. And if you have bad stuff 1 year, you cut the company slack. It's a one-time charge. But let's say that you take this company, and every 5 years you notice a one-time charge of $1 billion. Now let me ask you the same question I asked you before. Earlier I just ignored it, right, saying it's gone. But now I've thrown a wrinkle here. It looks like it shows up once every 5 years, which means that it's really not a one-time charge. It basically looks like you have an annual expense that you're summing up and taking as a one-time charge once every 5 years. So let me ask you the same question I had before, which is you have a minus $500 million loss, but it's because of a $1 billion write-off, so-called one. But now that you've looked at the numbers, you're convinced it's not a $1 billion write-off, that it's not one time. How would your answer change? Previously, it was you went from minus 500 back to plus 500. You added the entire billion back. Now, how much would you add back? How much? You'd still add zero, even though it's only one. Because if you add zero, then you're acting like there's a $1 billion loss every year. And if you know, so in effect, you're over penalizing the company, right? I would add back 800 million. You see why? Because their true expense is 200 million, and by showing it once every 5 years, they're giving me this loss and then big profits for the next 4 years. What it also means is when you look at your company and you look at the financials, please don't stop with just last year's numbers. Look at the year before. What you're looking for are patterns. things that show up every 3 years or every 4 years that the accountant, that the company is hoping you'll just miss because it looks, they call it extraordinary, one-time restructuring. Don't fall for the words. Look at the numbers and make your best judgment on whether this is truly something that's extraordinary, in which case you add it back, or is it something that's just being summed up over time and taken every 3 or 4 years? And the only way to answer that is to look across time. One of the nice things about S&P Capital IQ is you can download the data for the entire life of the company pretty much. And you can get all the revenue numbers, all the operating income numbers. So you can get 25 years and you can download and just take a look. Or you can download an Excel spreadsheet and essentially see or look for patterns in the numbers. So that's extraordinary and one-time charges. Just be careful. They might not always be extraordinary or one-time. Any questions on that? Let's take a different issue. Okay? Whether you like it or not, ultimately we're building these castles based on accounting statements, right? We've talked about it. We've dumped on accountants for being inconsistent, for being late. But you know, one unforgivable offense if you're an accountant is if you're committing fraud. Because if you're committing fraud, no matter how good I might be at estimating cash flows, I'm building cash flows that are built on sand. So you're saying, why don't I just look at my 10K to see if the word accounting fraud is mentioned? I'll save you the trouble. You will not see fraud mentioned directly until it's after the fact, right? So there's an area of accounting called forensic accounting. I don't know whether you've heard about it, where accountants look through annual reports looking for clues as to whether there's fraud underneath. I'll give you one very simple thing that they look at that seems to have predictive power. You know how in your income statement you have an income number. That's called accrual income, right? And then if you look at the statement of cash flows, there's a cash income where you take the accrual income, you adjust for working capital and all the rest of the stuff. And in any healthy firm, some years the accrual income will be higher, some years the cash income will be higher, but they move back and forth. But let's say you consistently find a company where accrual income runs ahead of cash income. That's a red flag. It's a red flag that the company's posting income and then using working capital as a way of delaying the cash flows. I'm not saying it's a perfect predictor, but forensic accounting is about coming up with flags like that. I won't go through the whole list. But basically, if you're interested in forensic accounting, I'll send you a link today. It's actually a very readable book that you can get on Amazon. It's about $10 on things you can look for in a financial statement that might be a predictor of fraud underlying the statement, in which case you should be a lot more careful about taking those stated numbers and using them. Right? So accounting fraud, I can't give you an easy fix for because I don't even know where it shows up, but at least you can start to get a little more skeptical about those stated numbers. Because this goes past just inconsistency or restating. This is just numbers that are not based upon reality. Now let me talk about money-losing companies. How many of you, who's doing the money-losing company? Or, obviously you'd have picked a company for this to be true. Right? So, okay. If you don't know what kind of company you're doing, at least take a look. If you're a money-losing company, I'm going to give you a framework for thinking about what to do next. You know the biggest problem with money-losing companies is? The minus sign in front. Because so much evaluation is built upon taking the base year, applying growth rate. So the way if you get too low a value, what do? Increase the growth rate. Right? That's not going to work with a money-losing company. You take a loss and you put a higher growth rate, the loss will just get bigger. So you've got to make the minus into a plus. I know this sounds simplistic, but that is the core of what you're trying to do. So let's go through the ways in which you can deal with the money-losing company. To value a money-losing company, the fundamental question you have to answer is, why is my company losing money? It sounds like an incredibly stupid question. You're saying because the expenses exceed the revenues. I know, that's why you're losing money. But there has to be a fundamental reason. Let's go through the possible reasons. The first is, it could be a truly one-time charge. Boeing every decade or so has a problem. Their entire workforce goes out on strike and they lose a quarter's worth of production. And when they do, they lose about $1.5 billion to $2 billion because they've got to get all those assembly lines back and running again. So in those years, they lose money. That's a one-time charge. And if that's the reason that you're losing money is you had a big strike and it cost you, you're going to add it back. You're valuing an insurance company in 2006, right after Katrina. Every single insurance company was losing money. Why? Because they had a catastrophic risk they had to cover. You could argue that unless you believe catastrophic risks are going to be every 5 years or 10 years, you can say, look, those losses reflect something that happened last year. So those are your easiest money-losing companies. Something obvious you can point to and say, that's why I'm losing money. I'm going to take it out and compute the income. Take a second reason you might be losing money. You could be a commodity company, an oil company. Shale oil companies, for instance, many of them are losing money. Why? Because they were created when oil prices were $80, $85, $90 a barrel. Now that oil prices are closer to $60 or $55 a barrel, the cost of extracting the oil actually exceeds the price, but they can't stop. Why? Because the fixed cost is already there. So the cost is not going to go. So on a variable cost, they might as well get the oil out and sell and get as much cash as they can. But if you look at their financials, they'll be losing money. Cyclical companies in a recession will lose money often. Why? Because the economy has gone into recession. With commodity and cyclical companies, you can't normalize income. Why? Because it's not going to go away overnight. So here's what you have to ask. Over the course of a cycle, what does this company do? You think, well, that requires defining cycle. So if you define a cycle as lasting 10 years or 15 years, you look at the average income over those 10 or 15 years. And you say, okay, once the cycle gets back to normal, that's what I expect the company to make. And again, you can't assume the company will go to that next year. You might say it'll take 2 years to get back to that. So I'm going to assume that in 2 years, I will earn 8% margins, which is what I'm making across the cycle. So with commodity and cyclical companies, you will bring the company back to making money by assuming that they will revert back to what they can make in a normal period of the cycle. But let's take the most difficult case. You have a money-losing company. It's never made money. It's a young company, right? It's a feature, not a bug. So if you're valuing Airbnb when they go public this year, or Uber when they will go public in 2 months, Uber has never made money. In fact, each year it's lost more money. Young companies. Losing money is not the end game. You could end up with still a very valuable company. But for this company, here's what you will need to do. You will need to target a margin. And we'll talk about how, I'll take you through the Uber valuation, Twitter valuation. You say, once my company gets through the growing pains and becomes a mature company, what kind of margins would I expect it to have? So if you look at a company like Twitter, it's an online advertising company who's losing money when they went public, but a typical online advertising company in steady state has huge margins. Why? Because there are very few expenses. Alibaba has 50% margins, Facebook has 40% margins, Google has 28% margins. So with Twitter, I assume that once they got past their growing pains, that their margins would converge on 25%. But it wouldn't happen until year 10. So over the next 10 years, I had to coax them from where they were, which is big negative margins, into positive margins. You're saying, how the hell would I know whether I'm right? You won't, but you have to make a judgment on what business they're in, what margin you're going to target towards. So those companies, you actually have to move the losses to profits gradually over time. So if it's a one-time charge, just ignore it. Your problem goes away. You've got positive income. You can value it. If it's a cyclical or commodity company, you've got to look across the cycle and think about how your company will get back to the middle of the cycle. But if it's a young startup or a company with early in the life cycle problems, you've got to coax it back to profit. But the end game is ultimately you've got to show profits. If you can't make that happen for your company, then you got the DER problem. You got a company that's worth nothing. And that could very well be a conclusion for your company. This company is going to be worth nothing. But you got to work your way to that conclusion. Any questions about money-losing companies? So we've talked about earnings and cleaning up earnings and one-time charges and all the rest of the stuff. Now let's talk about getting from earnings to cash flows. To get from earnings to cash flows, I need to estimate how much a company will have to reinvest. And if you think about reinvestment, now before you do that though, you first have to convert your operating income into after-tax operating income. So let's get that stop done first. So you got your operating income for your company. It could be a money-losing company that you make into a money-making company. Now you're asking, what tax rate should I apply? Remember this, I asked the same question when I did cost of debt. And there, what did we decide we should always use? The marginal tax rate. The rationale being interest saves you taxes at the margin. Here I'm asking a different question. This is a tax rate I'm going to apply on all of your operating income. So I'm going to give you some choices, and you tell me which of these choices you should use to come up with after-tax operating income. I could use the effective tax rate, which is just the taxes divided by taxable income in the income statement. I could use a tax rate based on taxes paid and operating income. I'll get a lower tax rate than the effective tax rate because I'm now dividing not by taxable income but by earnings before interest and taxes. I could use the marginal tax rate of the country in which the company operates. I could use a weighted average marginal tax rate across the countries that the company operates. Maybe the answer is none of the above. Or maybe this would be great if this were the answer. You can use any tax rate you want as long as you stay consistent about using that tax rate all the way through. If that were true, what tax rate should we use in every company when we value the company? Just use a zero tax rate. So obviously that's not the right choice. So my question is effective tax rate, taxes divided by EBIT, marginal tax rate of the country you're in, or weighted average marginal tax rate. You think effective tax rate? Let me play along. Let's say I took Apple and I used a 16% effective tax rate. When a company pays an effective tax, why do companies have effective tax rates that are lower than their marginal tax rate? It's not tax brackets like individuals, right? Because you hit the top tax rate for companies at about 2 million. So if you're a company with 100 million, 200 million, it can't be tax brackets. So you defer taxes, right? And legally, you're deferring taxes in the future. Now let me take your game and let's say I use a 16% tax rate next year. Does that happen? Sure, that's good. That's possible. 2 years from now, okay. 3 years from, and I keep doing this all the way, not just for the next 10 years, but forever. What have I just done? What have I assumed about deferred taxes? That you can defer taxes forever. And if you believe that, there's a padded cell in a federal penitentiary waiting for you. You can defer taxes, but they eventually come back to you. You know when your growth starts to slow down. That's why you notice effective tax rates start to climb as companies age. So I'll split the difference. I agree with you that the effective tax rate is probably the best tax rate to use early in evaluation. But as I get closer and closer to my terminal value, I have to start thinking about my marginal tax rate. And the question then becomes, which marginal tax rate should I think about? If you want to be just safe, you can just use the local marginal, which right now is 20. It used to be a much bigger issue 2 years ago when the US marginal tax rate was 40% and the marginal tax rate outside the US was 23, 24. Now it's close to 25% globally. So that's what I would use as my steady state. But if you're in a country with a very low marginal tax rate, like Ryanair, right? Irish company, 12% tax rate, I'm not going to use the 12% tax rate in perpetuity because it gets more, you get taxed on where you make income, not where you're incorporated. That's why all this talk about tax evasion by having a dummy corporation in the Cayman Islands makes no sense because you don't sell. The only kinds of companies that can do it is companies that sell into cyberspace, like reinsurance companies. But basically, if you're an automobile company, having a Cayman Islands subsidiary is not going to save you taxes. So if you're Ryanair and you ask me what tax rate should I use, I'm going to go with the global average because you are a global airline or moving towards being a global airline, and that's what your tax rate is going to end up being as you get to be a bigger company. So start with the effective tax rate, and if you want to leave it at the effective tax rate for the next 10 years, go ahead and then move it to the 25%. I actually start moving the tax rate. If you look at my Excel spreadsheets, I take the effective tax rate. I ask you, do you want me to use the effective tax rate? I give you that, the choice. And if you say use the effective tax rate, I use it for the next 5 years, and then I move it between years 6 and 10 towards the marginal tax rate. My rationale being, I can't allow you to defer taxes in perpetuity. What I'd like you to think about, though, is these are the kinds of questions that come up in valuation. And what I want you not to do is do a Google search, because that's what people have become used to, right? What tax rate should I use? Let me go look at a Google search. Reason your way to an answer, then do a Google search if you want to, but don't let that become a crutch that you use anytime you have a question. See if you can reason your way, because this isn't rocket science. Essentially, the effective or marginal tax rate question boils down to what am I trying to do and why am I using the effective tax rate? I'm trying to compute a tax rate on all of my income, and right now I'm paying only 16%. That's what I'm going to use for the near term, but eventually I think that rate is going to move towards the marginal tax rate. So the right tax rate to use is really a function of where you see your company evolving. If you want to use the effective tax rate all the way through, I think you're going to overvalue your company because you're not allowing for the deferred taxes to catch up with you. If you use the marginal tax rate all the way through, I think you're undervaluing the company because you're forcing the company to pay 25% in taxes even though it has these deferrals that will allow it to pay less than 25%. And that's my rationale for splitting the difference. And you can use both. Start with the effective, move towards the marginal. Now let's do one little tweak on tax rates. To pay taxes, you have to make taxable income, right? So if you're losing money, you cannot pay taxes. So let's assume you have a company that has $1 billion of net operating losses carried forward. You know what those are? Basically, every time you lose money, even though you cannot claim any tax benefit right then, you're allowed to carry those losses forward and claim them against taxable income in future years. So this company is a company that's accumulated net operating losses over time. It is $1 billion in NOLs. This company is expected to make operating income of $500 million every year for the next 3 years. So just in terms of pure mechanics, I want you to tell me how much I'll pay in taxes in year 1, in year 2, and year 3. So you have $1 billion in NOLs. You have $500 million in operating income every year. So how much will I pay in taxes in year 1? 0, because I have an NOL. So now my NOL is down to $500 million. I have another $500 million year 2, no taxes. Year 3, I have taxes. So 0 tax rate, 0 tax rate. You're saying, can my tax rate change over time? There's your answer. If you have a money-losing company, you should expect to see your tax rate change over time, which means when I compute my cost of capital in year 1, if I have debt, you know what tax rate I should be using for my debt? If I'm losing $500 million, what tax benefit is there to debt? My pre-tax cost of debt, my after-tax cost of debt should be the same in years 1 and 2, but as I start to pay taxes, my after-tax cost of debt is going to show up the tax benefit of debt. So don't just routinely multiply the cost of debt by 1 minus t. To do that, you actually have to start making money. Okay? Which means for those of you valuing young companies which are losing money, you know what you have to do? Not only do you have to track losses each year, you have to keep a kind of updated number of that accumulated loss. And when you start making money, give yourself the benefit of having an NOL. So if you look at my spreadsheet for the DCF, I actually keep track of your losses, and you see that NOL kick in the first years that you make money. And eventually when the NOL runs out, I push you towards whatever you tell me your tax rate has to be. So little tweaks, but something worth thinking about when you think about what should I put in as taxes when I do my, so if you want to build your own spreadsheet, you can, but when you put the 1 minus t, always put the if statement. You have the 1 minus t only if you have taxable income and you get a tax benefit from interest expenses. Now comes the reinvestment part. If you look at any standard estimate of free cash flow to the firm, you start with after-tax operating income, and we talked about how to get that. And you subtract out the difference between capital expenditures and depreciation. But these are line items you see in an accounting statement. There's a CapEx line item in the statement of cash flows, and there's a depreciation line item, and people often just project those line items out. But the way to think about this difference between CapEx and depreciation, it's what you're adding to your long-term assets. That's what a net CapEx is, the increment on your long-term assets. You say, why do I want to increase it? Well, if you want to grow, you have to put money back in the firm. And the net CapEx then is how much you're putting back into the long-term assets of the firm. Which means that if you're going to make assumptions about net CapEx, those assumptions have to be tied to the assumptions you make about growth. Do you see what I mean by that? If you're assuming high growth for a company, the first item I'm going to check is your net CapEx. And if you have very little going into net CapEx, I'm going to ask you what's going on here. Why is it maybe you have a really good explanation. Maybe the margins are increasing over time. But when you see high growth, you should see high net CapEx. When you see low growth, you should see low net CapEx. When you have no growth, maybe you'll have no net CapEx. You know what no net CapEx would be? CapEx offsets depreciation. But if you have growth, the net CapEx should reflect it. So those assumptions have to be locked in. That said, though, staying with the accounting definition of CapEx, and you saw this last session, is going to get us into trouble. For technology firms, for pharmaceutical firms, your big investment in long-term assets, it's not land, building, equipment, machinery, factories, it's in technology, it's patents, it's R&D. So when I expanded the definition of CapEx, I brought in R&D expense into the CapEx and said that should really be CapEx. I amortized the research asset I got, so that should be like depreciation. But I'm going to add one more item to this list of what you should think about when you think about reinvestment. Let's say you're a company, you're in a hurry. to grow. Taking projects takes so long. So when companies are in a hurry to grow, how do they try to grow fast? What do? They do acquisitions. To me, acquisitions are just gigantic capital expenditures. But for whatever reason, they've had their own set of rules. So when you're a company growing through acquisitions, I should be counting the cost of those acquisitions just as I would traditional CapEx. I'll give you an example of a company where most of the CapEx took the form of acquisitions. Cisco in the 1990s went from being a $4 billion company in 1990 to a $400 billion company in 1999. There was a brief period in 1999 where Cisco was the largest market cap company in the world, 4 to 400 billion. It grew 100-fold, and it did it almost entirely with acquisitions. They bought 15 to 20 companies every year. And they were actually very successful with their strategy, usually young companies with promising technologies. What Cisco brought to the table was almost a SWAT team. They would acquire a company with the technology, and the SWAT team would arrive, and they would convert the technology into a product, and they would make money in the product. So if you're valuing Cisco and you ignore acquisitions when you do CapEx, here's what you're going to see. Really high growth with very little net CapEx, and it's going to look magical. You're going to say, this company was able to grow with no reinvestment. The reality is their reinvestment took the form of acquisitions. And many of their acquisitions they paid for with stock, and to me it doesn't matter how you pay for them, because the very fact that you did acquisitions means I have to count them as CapEx. Here's the problem you're going to face if your company is like Cisco. Where do you find CapEx? You find the statement of cash flows, right? If your company grows through cash acquisitions, you'll find it in the statement of cash flows too. But if your company grows by acquiring other companies and paying with stock, you won't find it in the statement of cash flows because it's not a cash outflow. It'll show up as a footnote, which means that to value a company like Cisco, I can't just start with and stop at the statement of cash flows. I've got to go look at those footnotes to see what other acquisitions you did with stock, because that collective number is what I will use as my net CapEx. So my definition of net CapEx will start with the accounting CapEx and depreciation, but it'll also bring in R&D, it'll also bring in acquisitions. And how much of a difference can it make? Well, there's Cisco in 99. Just 1 year, they did 9 acquisitions, or 8 acquisitions. Notice it says method of acquisition. Until 1999, US companies could account for acquisitions in one of two ways. One was called pooling and the other was purchase. When you did purchase acquisitions, you had to show goodwill. When you did pooling, you paid entirely with shares and you didn't have to show it in your balance sheet. It was like a loophole where companies could do big acquisitions and nobody would notice. So if you look at the first 3 acquisitions, they were all pooling acquisitions, which means I didn't see them in the statement of cash flows. I had to go digging through the footnotes to find them. And here's what I found. It gave me the date of the acquisition, the company acquired, and the number of shares that Cisco paid for the company. So to complete this, I had to go look up the stock price on that acquisition date. You're saying, what a pain in the neck. You're valuing a Cisco. You have no choice. This is the way they grow. You've got to get a number, and that number is going to become part of my net CapEx. So for Cisco, you'd say the way this pays out is if you look at the traditional statement of cash flows, my statement of cash flows said my CapEx was $584 million. You subtract out the depreciation, and if I just stopped there, I'd have told you Cisco's net CapEx is $98 million. I'm done. But then I capitalized R&D, which added another $1 billion to the net CapEx. And then I brought in acquisitions, which added another $2.5 billion. If you ask me, how much did Cisco reinvest in 99? It's not $98 million. It's not even $1.5 billion. It's almost $3.5 billion if you include acquisitions. GE played this game really well between 1985. This was part of Jack Welch's mystique. Was GE used to be, in the early 80s, had become a mature company. It was growing at 2 to 3% a year. Then Jack Welch became CEO, and it magically started growing at about 7 to 8% a year. And one of the ways it grew is it did a lot of acquisitions. But unlike Cisco, the acquisitions were kind of mixed in with this, with stuff that covered it up. So many analysts valuing GE in the late 80s or 90s would put in the 8% growth rate because that's what the company is growing at. They'd go to the statement of cash flows, pull up CapEx and depreciation and put those in, but those did not include acquisitions. And magically, GE was worth a lot of money because they were able to grow with very little reinvestment. If you want to count the good stuff that comes from acquisitions, you have no choice but to count the bad stuff. The good stuff from acquisitions is you now get higher growth, higher earnings, higher revenues. The bad stuff is you have to pay for the acquisition. That becomes part of your reinvestment. Doesn't mean it's bad, because net effect could still be positive, but the key is to look at that net effect. So reinvestment has to be defined much more broadly than just capex minus depreciation in your statement of cash flows. And finally, working capital. What's your accounting definition of working capital? Humor me. It's current assets minus current. That's how we were all taught working capital, right? That is not the definition we use in valuation. Here's my modified working capital definition. It's a difference between non-cash current assets and non-debt current liabilities. Let me take the easier half of that equation first. If you look at current liabilities for a company, you'll see accounts payable, supplier credit, short-term debt, short-term portion of long-term debt, deferred this, deferred that, deferred everything under the sun. I'm going to take the short-term debt and the short-term portion of long-term debt out of the account, out of the current liabilities, and I'm going to treat them as debt for my cost of capital. So I'm going to basically give them all a long-term cost of debt. So I'm going to so that's why I don't count debt when I do current liabilities. Why do I exclude cash from current assets? Every accounting definition leaves cash in there, right? You're saying, how much of a difference will it make? Think of Apple. If I leave cash in there, their working capital is like 260 billion. If I don't leave cash in there, it's like 4 billion. So why do I exclude cash? Let me ask you a different question. Why the heck do we even care about working capital? So what's the big deal if you have a lot of inventory? Why does it affect your cash flow to have a lot of inventory?
It means you've got liquidity tied up.
Basically, you got money tied up on the shelves, right? When you have a lot of inventory, that money is tied up and you will not get it back until you sell. So when you have a lot of inventory, that's cash tied up. So inventory is a cash flow effect because it's a wasting asset. You sell items on credit and you don't charge interest. That's a wasting asset, right? Because until you collect the money, you're essentially giving an interest-free loan to your customer. So the question with cash is it a wasting asset? Or what has to be true for cash to be a wasting asset? When you look at a company like Google or Apple, 250 billion, 100 billion cash, where is that cash usually invested? Is it kept in stacks of currency around Apple? If it were, I'd be breaking into Apple every single conceivable way and trying to steal 250 billion. When you have 100 billion, 250 billion cash, it's invested in. It has to be invested in something short-term and something liquid. Commercial paper, T-bills. So right now, what do you think the cash is making? About 1% maybe, 1.5% if they're lucky. So that's a wasting asset, right? You're making only 1.5%. But let me ask you a question. How many of you have brokerage accounts where some of your money is in cash? I do. It makes me weep when I look at what that cash has earned for me last year. Because you know what it made for me? About 1.5%. Why? Because I have the same problem that Google and Apple have, which is right now, short-term rates are low. And if I want to take no risk, that's what I'm going to earn. Do you see where I'm going? Even though cash earns only 1 or 1.5%, if it's invested in marketable securities, in commercial paper or T-bills, it's not a wasting asset. It's earning a fair rate of return given the risk and the liquidity that I wanted with that investment. So cash, for the most part today around the world, doesn't sit around in stacks of currency. It's invested in fair market investments which earn a fair rate of return, so it's no longer wasting cash. You're saying, what has to be true for cash to be wasting? You really have to be sitting around with stacks of currency. What kind of business will you be? Maybe you're a drug dealer. And you want me to value a business first. I'll be very wary about valuing a business. What if I screw it up? You might lose your temper and do terrible things to me. But then I might say, you know what, cash is part of your working capital. But if you're running any kind of legal business, it's very difficult for me to visualize a scenario where cash is a wasting asset, which is part of the reason I compute working capital. I just completely ignore cash. You see, what if it's operating cash? This is one of those biggest wastes of time I've heard in valuation. What if it's operating cash? McKinsey used to have this rule of thumb that you needed 2% of your revenues in operating cash. What's operating cash? I'll give you the best case definition of operating cash. You're a company like Walmart. You need cash in every till. You know why? Because people pay with cash. You have to give them change back. If you have nothing in the till, people come in with a $100 bill. You say, no, sorry, you can't buy stuff today. So you need cash in the till. So McKinsey's rule was, hey, if you're an operating business, 2% of your revenues. You know what 2% of Walmart's revenues would be? It's about $6 billion in cash. This weekend, if you have nothing better to do, hang out around a Walmart. Avoid those greeters. No, safe distance away. What you will notice every 2 hours is a Brinks truck will drive by. It'll stop. They'll clean out the cash registers. Walmart knows that cash in the till is wasting cash. So what they do is they try to get that cash into something that earns a fair market rate of return. And as people shift away from paying with cash to credit cards, the need for operating cash just dissipates. So rather than this debate about how much operating cash do I need, ask yourself, is it wasting cash? Because if you have a cash requirement for your business where you can earn a fair market return on the cash, it's no longer wasting cash. It should not be part of working capital. So when you look at your company and ask, how much has my company reinvested in the past? You can take the net capex with the expanded definition, include R&D and acquisitions, and you can try to look at working capital over time. What was the change in working capital last year, the change? It's only the change that you have to worry about because what's already in there you've already paid for. So it's only the increase in working capital that's a cash flow. But here's one of the things you're going to find. Working capital is an incredibly volatile number. So if you take the change in working capital, here's what you're going to see. 1 year you get a plus $2 billion cash flow. Next year it's minus $2.5 billion. Third year it's plus $1.5. Changes in working capital on year to year are incredibly volatile numbers. So if you take just last year's change in working capital and you make that a base for your valuation, you're asking for trouble. So what choice do I have? Here's a very simple way to clean up working capital. Rather than look at the change in working capital from year to year, look at non-cash working capital as a percentage of revenues. That number won't jump around as much. So it'll be 7, maybe 6.5, 5.5, 7.5. Let's say the average over the last 5 years is 7%. Then project out revenues for next year. So let's say you expect revenues to go from $1.5 billion to $2 billion. So you're expecting a good year. If this company needs to maintain 7% of revenues as working capital, if your revenues go from $1.5 billion to $2 billion, how much will their working capital change? That's $500 million in additional revenues. They need to set aside 7% of $500 million. So when I do my reinvestment next year, I'm going to take 7% of the extra revenues, and that's going to give me working capital for next year. It'll make your life a lot simpler if you do that rather than compute year-to-year changes and try to make sense of those changes. So it's an easy way to clean up your numbers and kind of move forward. And finally, one final point, and this will happen to a fair number of your companies, especially if they're not manufacturing companies. Working capital, I said, was the difference between non-cash current assets and non-debt current liabilities, right? Can that number be negative? Can non-debt current liabilities be greater than your non-cash current assets? Yeah. And when that happens, it creates a bit of a problem. And here's why. Let's say that number is negative and your revenues grow. Let's take the example which you had. Let's say your non-cash working capital is minus 5% of revenues, and your revenues go from $1.5 billion to $2 billion. What will your change in working capital next year be? Minus 5% of 500 billion is minus 25 billion. You're going to give your company a $25 billion cash flow, positive cash flow, because they're growing fast. You grow another billion, that's another. So in fact, it becomes a source of cash flows. A negative working capital becomes almost a magnet for you because it means your cash flows will get more positive as you grow faster. And there are companies that have been built around negative work, because basically what you're doing is you're letting your suppliers become your capital providers. You're using supplier capital as a basis for growth. Amazon, when it first started, this actually, if we go back in time, in the early 60s, maybe 70s, accountants had this rule of thumb for companies that your non-cash working capital should be twice, or your current assets should be twice your current liabilities. A current ratio of 2 was supposed to be a good ratio. I don't know who makes up this crap, but that's what people believe. Until Walmart came along and said, that's stupid. If our current assets are twice our current liabilities, that means our working capital is going to be a huge drain in our cash flows. We're going to try to make that number closer to 1. And they did it with inventory, just in time, squeezing their suppliers. Effectively, they brought down inventory and they tried to make working capital, in which case working capital becomes a 0, right? It doesn't even affect your cash flows. Amazon decided to go one step further. They said, why stop at 1? Why not go below 1? Why not let our... And the way this worked very simply early in Amazon's days is they would get books. They were originally a book retailer. They'd get the books from the publishers. They wouldn't pay for the books. They'd get 60 days. They'd sell the books to you and I, and we didn't get 60 days. They kind of insisted we pay right away. They'd collect the cash, and they'd wait 55 days to pay the suppliers. So the non-cash working capital became a way in which they could grow faster. And that model has been adopted by a lot of young companies which try to play this game of, if I can use supplier credit. And it's not a freebie, because that supplier credit comes with hidden costs. But the costs are hidden, so your investors don't see it. The company looks pretty good. So negative working capital is always messy because you don't know what to do next. But my suggestion is kind of hang in there, let the negative working capital be a source of cash, just like low effective tax rate for a period, but at some point in time, it has to stop, because you can't let working capital be a source of your growth for the rest of eternity, because then your working capital will become an infinite number. It'll start to drain your company. So here's an example. In my first edition of the Dark Side Evaluation was in 2000, and I valued just tech companies. And 3 companies I used were Amazon, and I valued Cisco and Motorola. So if you look at Amazon, their working capital was negative, minus 25.53% of revenues. Young company using working capital to grow. Cisco was minus 3.32%, not as negative as Amazon, but still a source. And if you looked at Motorola, it's 8.23% of revenues. So when I valued these 3 companies, here's what I did. For Amazon, as I projected numbers out, I assumed that as they got larger, it'd get more and more difficult to have this float. That at some point in time, you could not ask suppliers to keep waiting for 60 days while you collected cash. So when I did my valuation, I actually moved the numbers towards an industry average. I actually set it a little below industry averages, and here's why. If you're a traditional book retailer in the late 90s, you had to have a lot of inventory, which I call show inventory. You know what show inventory is? You go into a bookstore, there's this big chunk of Harry Potter books right in the middle that everybody buys, and the rest of the bookstore where nobody really goes. But if you're a bookstore, you're supposed to keep a philosophy section and keep it stocked, even though nobody buys those books, and the literature section and keep it stocked, because you're supposed to maintain show inventory. Amazon had no such delusion. They said, if everybody buys Harry Potter, we'll keep Harry Potter. You want a philosophy book? Let us know. We'll let the guy write the book for you and get it to you in about 6 months. But you're not particularly high on our list. It means that online retailers can keep much smaller inventory than brick and mortar retailers. So that was my reasoning for assuming that, but I assumed that their working capital would still become positive, a drain on the cash flows, but not as big a drain as it would be for a brick and mortar retailer. When I looked at Cisco, their percent of revenues was minus 3.32%, but the rest of the sector was just like that. This was not just a Cisco specific problem. This seemed to be something that everybody in the business was doing. So when I forecast out the cash flows, I initially gave them the working capital as a potential cash inflow. But as I moved through time, I moved that number to 0, saying I can't let you keep growing and get cash flows from working capital. And finally, for Motorola, 8.23% was their actual number. The average for the sector was 7%, but Motorola seemed to have this history of having more working capital than the rest. And you could see that by looking at their averages. So I left the number 8.23%. My point is, there is no one rule that's going to work for every company. You've got to look at your company, you've got to look at the industry, you look at the other companies before you make your judgment on, hey, what am I going to do for your company? Okay. So that is cash flow to the firm. Let's review. You take operating income, clean it up for one-time charges, make sure you capitalize R&D, capitalize leases. You multiply that operating income by 1 minus the tax rate to capture the tax effect, and use an effective tax rate to start but move towards a marginal. Subtract out reinvestment, which can take the form of both net capex, which includes acquisitions and R&D, and working capital, where you might have to smooth out the numbers. And you're going to come up with free cash flow to the firm. But it's a pre-debt cash flow. But let's say you want a free cash flow to equity. The question I'm asking is, as an equity investor, what's left for me? To get to free cash flow to equity, I'm going to have to subtract out cash flows to debt holders. I mean, of course, there is a much simpler proxy for the free cash flow to equity, which is what does a company actually return to shareholders as dividends? You're saying, why don't you just use this? Why are you going to this extra trouble of computing this free cash flow to equity of potential dividend? Because most companies don't pay out what they can afford to in dividends for lots of different reasons. One is managers are conservative and like to hold back cash. That's one. For good reasons or bad. I'm not saying they shouldn't, but they do. The second is, if you look at some companies, they might actually pay out more in dividends because they think that'll get them a higher stock price. So What you see as actual dividends can be different from the potential dividends, and the only way to check to see if that is true for your company is to actually compute what your company could have returned as dividends, potential dividends. So let's talk about estimating free cash flow to equity. And you're going to see that the process by which I do this is not that different from the process I do free cash flow to the firm, but everything has to be tuned to the fact that I'm now looking at equity investors. So here's my first start at potential dividends. Here's what I cannot do. There are some analysts who actually discount earnings and claim that's potential dividends. In a very loose sense it is, right? I can pay out my earnings as dividends, but if I do, I'm not going to be able to grow. If you discount earnings, so if you see a discounted cash flow model where people are discounting earnings, and they are putting in a positive growth rate, something is clearly off in that valuation. So if you want to use earnings as dividends, then put in a zero growth rate, and over time you'll essentially pay out all your earnings as dividends. So for potential dividends, I have to factor in how much the company has left over after every conceivable need has to be met. So here's what I'm going to do. I'm going to give you my definition of cash flow, free cash flow to equity, and I want you to contrast this definition to the free cash flow to the firm. Instead of starting with after-tax operating income, I'm going to start with net income. Why? Because I want cash flows after debt payments. Net income is after interest expenses. And why am I not multiplying net income by 1 minus T? It's already after taxes, right? Net income is already the bottom line. It's after taxes have been paid. So I'm going to start with net income. Then I'm going to subtract out net capex and change in working capital, exactly the same line items I subtracted out to get to free cash flow to the firm. So it's not a different definition. And then there's a new line item that I did not have when I did free cash flow to the firm. Remember, when I borrow money, cash comes into the firm. When I repay debt, cash leaves the firm. So I'm going to look at the net cash flow from either adding debt or paying down debt. If I'm paying down debt, that's going to be a cash outflow. But if I'm adding debt, there's going to be a cash inflow. So if I'm a company that borrows more than I repay, that's actually good. It's kind of counterintuitive, because I'm saying if you borrow money, your free cash flow to equity will be higher. But hang in there, that's exactly what's going to happen. Your free cash flow to equity will be net income minus reinvestment minus this cash flow effect from either borrowing money or repaying money, the net effect. Take a look at those line items. Every single line item will be on your statement of cash flows, right? Net income is the starting line item. Change in working capital is right below the operating cash flow. The capital expenditures and cash acquisition should be in the investing section. And then the debt repayments should be in the financing section. Everything you need to compute free cash flow to equity will be in the statement of cash flows. Don't go to the net income statement. Don't go to the balance sheet. Stay on the statement of cash flows. It is, in fact, the most honest financial statement, if you ask me, because it's cash in, cash out. You can't really play games unless you're committing fraud. So statement of cash flows, every single item. And I've ignored preferred dividends, but if you do have preferred stock, think of that as an outflow as well, because the way to think about it is you're the owner of a company. I'm looking to see how much cash is left in the till after you've met every conceivable need. Why? Because whatever's left in the till is cash you can take out of the firm. That is my definition of potential dividend. So let me take an example. Right? So, one more thing. When you do that, though, you have to compute net capex, change in working capital, and the debt component, where new debt gets coming in and debt gets repaid. And that can be a bit of a pain. I'll give you a shortcut you can use if you're willing to make an assumption. Remember, net capex and change in working capital is reinvestment, what you're putting back in the company, right? If you're willing to tell me that a fixed percentage that will always come from debt, you've decided your optimal debt ratio is 30%, that 30% of your reinvestment will always come from debt, 70% from equity. Here's the shortcut I can use. I'll still start with net income, but instead of subtracting out the entire reinvestment, I'll subtract out only the equity portion of the reinvestment. You see why? Because all I care about as an equity investor is how much do I have to come up with, and to the extent that 30% comes from debt, I have to come up with the remaining 70%. It's a shortcut that works if you have a company that has a very stable debt ratio. So for companies that are mature companies that always fund their operations with 25% debt, 75% equity, this will give you the free cash flow equity, but you're still getting to the same end game. How much cash do I have left over that I can pay out as dividends? So let me give you the example that I'm going to use. I'm actually going to play through. So the statement of cash flows, every single line item is in there, so you can always compute this. but the company I'm going to use actually is Disney. But before I do that, let me back up and show you why I do this. Every year when I take my 43,000 companies, I look at their dividends and buybacks. That's the actual cash return. I also look at the free cash flow equity, because the definition I've given, I can compute this for every company. And basically, I wanted to see around the world what percentage of companies accumulate cash, because if you pay out less than your free cash flow equity, you're accumulating cash, the Googles and the Apples of the world. What percent of companies are paying down cash? Because every time you pay dividends that exceed your free cash flow equity, you're paying down your cash balance. And here's what the world looked like in 2018. Across the globe, about 47% of companies accumulated cash. Basically, they paid out less than their free cash flow equity as dividends. The difference goes into the cash balance. About 53% of companies paid way too much in cash, more than their free cash flow equity. There's this, when you ask most people why they don't like to use free cash flow equity models, their argument is you're going to get too high a value for the company. They seem to implicitly assume that free cash flow equity is always higher than dividends. And what this table says is, if you focus on discounting dividends, there are lots of companies who are going to overvalue the company because these companies are paying dividends that really cannot afford to pay out. There are differences across the world. For instance, if you look at Japan, Japan has the smallest percentage of cash accumulators and the largest percentage of companies that are paying out more cash than they have available. What does it mean? If I use a dividend discount model in Japan, a lot of stocks are going to look cheap to me when in fact they're just paying out a lot more than they can afford. So look across the world and you can see Australia, New Zealand, Canada has the exact opposite problem. And there I think the answer might be because they have so many natural resource companies. They're actually holding back cash because they know there's going to be downturns coming. They're going to cover those downturns. I'm not giving them an excuse, but it does mean that in New Zealand and Australia and Canada, if I use a dividend discount model, I'm going to come up with values that are too low for a lot of companies because I'm missing that free cash flow equity. So the reason I focus on free cash flow equity is I don't trust dividends. Dividends are set by managers. I have no idea what that number actually tells me. So I'm saying I'm going to, and it's not difficult, right? Statement of cash flows is right there. It takes 5 minutes to compute your free cash flow equity. It's not rocket science. I just want to make sure that what your company is paying out is what it could have paid out. And if it's not, I'm going to go with what it could have paid out as my basis for valuation. So in my corporate finance class, I used Disney as my lab experiment. I run it through the class. So this is about a long time ago, 15 years ago or so. Net income for Disney was about $1.533 billion, or $1,533 million. Their capital spending was $1,746 million. Their depreciation, it says per share, scratch outside. Depreciation was $1,134 million. So if you net out capex against depreciation, they're reinvesting. The net capex is about $612 million, and the change in working capital is about $477 million. I'm going to use the shortcut because Disney at the time that I did this had a pretty stable debt ratio. They used about 24% debt, 76% equity. So ready? Let's do the free cash flow equity calculation. I'm going to start with net income, $1,533 million. From that, I'm going to subtract out 76% of $612 million. Why? Because I'm looking at just the equity slice of the reinvestment, and 76% of the working capital change, which gives me $363 million. I end up with a free cash flow equity for Disney, at least in the year that I did this, of $704 million. In that year, Disney actually paid out $345 million in dividends. With US companies, though, here's what I've noticed. The free cash flow equity is higher than the dividend, higher than the dividend, higher than the dividend. But in the fourth year, what does the company do to make up for it? It buys back stock. And that's why I count buybacks, is buybacks have become a way in, because companies, well, you're saying, why don't they just pay out the entire free cash flow equity in dividends? I don't blame the companies because the people who receive dividends are a little wonky. They seem to expect to get that dividend year after year. So companies are reluctant to pay the dividends in a good year because they know the next year they're going to be punished if they don't. So what they do is they hold back cash in good years, but every fourth or fifth year they do a big buyback. So this notion that buybacks have come out of nowhere again, I think misses the point. For most US companies, it's just become a way in which companies return cash at irregular intervals in large amounts, because that way you let it accumulate and then you pay it out. Okay? So that's my free cash flow equity. I'm going to play a little game here. I'm going to keep everything constant and just change the debt ratio. Let's say you're Disney CFO. If I make the debt ratio go from 24%, to 30%, what's going to happen to my free cash flow to equity? It's going to go up, right? If I go from 30 to 40, you can see why, right? Because at the less money that comes from equity, the higher. So if I stopped and just showed you the free cash flow to equity, this seems like a free lunch. As I go from 10%, 0% debt to 90% debt, my free cash flow to equity goes up and up and up. And so if I want to increase my equity value in Disney, all I need to do is use more debt, right? What am I missing? Because clearly this can't be the end story. Because if this were the end story, every company should be using 90% debt. These are free cash flows to equity, right? So what's the discount rate I should be using to discount these cash flows? Cost of capital or cost of equity? Cost of equity. To get a cost of equity, what are the three numbers I need? I need a risk-free rate, I need an equity risk premium, and I need a beta. So as my debt ratio goes from 0% to 90%, the risk-free rate and the risk premium don't change. But what happens to my beta? Remember we talked about a levered beta as you borrow money? So in this case, when I bring in the other half of the equation, this is what's going to happen to my beta. So my free cash flow to equity will go up as my debt ratio goes up. But so will my beta and my cost of equity. So my cash flows are higher, my discount rate is higher. The value of equity is the present value of the cash flows of the discount rate. So I want to bring the two together. Let's see how much of your corporate finance you remember. I know you remember nothing, but you don't need to because you could reason your way to an answer. So your free cash flows to equity will be higher when you borrow more money. Your cost of equity will be higher. My question is about the value of equity. And I'm going to read 4 statements and you tell me which of these 4 is the best description of what will happen to the value of equity as I increase my debt ratio. So here's the first one. Increasing my debt ratio will increase value because the cash flow effect will dominate the discount rate effect. Is that true? If that were true, what will happen? What's your optimal debt ratio for every company? It's going to be 99% debt. Let's take the second statement. Increasing leverage will decrease value because the risk effect will dominate the cash flow effect. This clearly can't be true either because if this were true, the optimal debt ratio for every company would be 0. Read the third statement to you and you tell me whether this is even possible and what it means. Increasing leverage will not affect value because your risk effect will exactly offset your cash flow effect. This is actually one of corporate finance's most famous theorems. What's the theorem? Come on, you've heard about it. It's a Miller-Modigliani theorem. The Miller-Modigliani theorem, the reason your value cannot change is you get offsetting effects. And you know what? It's not an unreasonable theorem. If you have no taxes and no default risk, that's exactly what will happen, is you'll get higher cash flows when you borrow money on a per share basis, but your risk will exactly increase to offset. But we don't live in a Miller-Modigliani world. Why? Because we have to pay taxes. At least I do. I don't know about you. And we have to worry about default risk. So the fourth statement actually is the best description. It could go up or down depending on where you are in the leverage spectrum. If you're an under-levered company, you have too little debt, increasing leverage, the cash flow effect will dominate the risk effect, but there'll be a tipping point where that's no longer going to be true. I don't know whether you did this in your corporate finance class, but if you did not, go and look at my corporate finance class. We go through an optimal capital structure section. And maybe I'll get a chance to revisit it later in this class. We'll talk about what's the right debt ratio for a company. The way we do it is by looking at this trade-off. And we say, for this company, the optimal debt ratio is 30%, but for that company, the optimal debt ratio is only 10%. This is another way of framing exactly that choice. So free cash flows to equity are post-debt cash flows. But if the way you're pumping up those free cash flows to equity is by borrowing more and more money, remember there's a consequence here. Your equity is getting riskier. And I'm not sure you're making your equity more valuable even though your cash flows might be higher. This, I think, is often what some real estate developers seem to miss. They're so focused on return on equity, right? And let's face it, the smaller the slice of equity you have, the higher the return equity. So they say, oh, this is great, my return equity is 63%. And many LBO guys seem to fall into the same trap. Look at my IRR, it's 38%. But if you're using 95% debt, a 38% ROE or IRR might not be high enough because you've taken so much risk on the shoulders of equity. So it's a simple and perhaps even simplistic way of thinking about how leverage affects value is to think about the free cash flow to equity versus cost of equity. I miss a page? Right. Let's talk about the value of growth. Right. Now, if I go to a company and I say I'm valuing a company and I say, what kind of growth rate would you like? Almost every company says, I like a high growth rate. Because on the face of it, a higher growth seems better than a lower growth, right? And one of the things I'm going to contest is that notion. Because growth is a double-edged sword. The good side of growth is your earnings and revenues grow faster. The bad side of growth is you got to set aside cash to grow. The net effect is what determines whether growth adds value, does nothing for value, or destroys value. So we're going to look at growth, but we're going to look at it through not rose-colored lenses and say growth is always good. We're going to ask those tough questions. There's growth, but is this value-creating growth, value-destroying growth, or value-neutral growth? So let's set up the process. There are three ways in which you can estimate growth for your company. And this is true for all of your companies. The way in which most people estimate growth is they look backwards. They look at historical growth. So what have I grown in the last 5 years, last 10 years? And that's not unnatural. Every one of you, to value a company, you should look at the last 5 years or 10 years. So we'll start with that, historical growth. The second way to think about growth is to use what's called a fundamental growth structure. Basically, you're saying to grow, a company has to reinvest and reinvest well at the same time. If I can measure how much a company is reinvesting and how well it's reinvesting, I can estimate the growth rate for the future. It's almost an intrinsic way of thinking about growth, saying I'm not going to look at the past, I'm going to forecast the future and think about reinvestment and return on capital. So that's the second way. In the third way that you can look at growth is you can basically ask other people, how quickly will we grow? Now, you'll be amazed at how many valuations, and you ask the analyst, where did you get the cash flows and the growth rate? The answer is by asking the managers of the company, which is a horrible place to go because you're going to get biased numbers, but it makes them feel like, hey, they know more about the company than I do, which is true, and use their numbers as my basis for valuation. So basically, historical growth, other people's estimate of growth. In fact, for each of your companies, there's a growth number out there that you can probably look up. If it's a company that's followed by equity research analysts, you go to Yahoo Finance, there's an expected growth rate for your company. And you're going to be tempted to use it, saying, look, I don't know much about valuation. I've never done a valuation before. These are equity research analysts. This is their job. They must know what they're doing. They're telling me 23% growth for my company. I'm going to use that as my growth rate. I'm going to try to talk you out of it, but I might not succeed. But we'll talk about why analyst estimates of growth are not very good estimates for the future. So historical growth, other people's estimates of fundamental growth. Let's start with historical growth. That should be easy, right? It's a fact. But to see how much historical growth can vary, let's think about the choices you have to make when you estimate historical growth. You take a company and ask you, what was your growth over the last 10 years? It's the first question you need to ask me. In what? Because it could be growth in revenues, growth in operating income, growth in net income, growth in earnings per share. And they can be very different numbers, right? Over what time period? Is it over the last 3 years, the last 5 years, the last 10 years? You can get very different numbers. And how am I going to compute the average? You can take the 10 years numbers, add them up and divide by 10. That's a simple average. Or you can look at geometric growth rates, which means you're looking at compounded growth. What I'm trying to say is we think of growth as a given. But growth has to be estimated with choices you make, and the choices you make can give you very different numbers. So we're going to talk first about how arithmetic averages and geometric averages can give you very different numbers. How some people use what I call quasi-sophisticated models to look like they're doing things with past numbers when in fact they're doing very little, regression models. And I'm going to argue historical growth rates can be very sensitive to starting points. One of the reasons, if you remember my historical risk premium that I computed for the US, one of the reasons that last 10 years look so good is when it's the start of, my last year is 2018, what is my first year for my 10-year? 2009. Which means I'm taking the 2008 base year where earnings had collapsed. So if I do a 10-year growth rate on pretty much any company I look at, I'm going to get this astonishingly high growth rate. So it's very sensitive starting point and ending point. And whether you're looking at operating income, revenues, net income. So we're going to look at that. And finally, one of the mechanical problems we're going to run into is how to compute even a growth rate if your company goes from a negative number to a positive number. Let me give you a very simple example. Let's say your company last year had minus 100 million, lost money last year, and this year it made plus 100 million. Let me start with the easy question first. Was this year a good year? Yeah, obviously, we're in minus 100 to plus 100. What's the growth rate you had in earnings this year? You see why it's going to be difficult? Because how do we compute growth? We take the change and we divide by the starting number. In this case, the starting number is a negative number. So if you mechanically go through the computation, you're going to come up with a minus 200% growth rate, which makes absolutely no sense, but mathematically, that's what you're going to get. And you're going to run into this with companies when you try to compute growth rates as you go from negative to positive numbers. So let's start with arithmetic averages and geometric averages. And I promise you we'll end with this, and we've had enough for today. Motorola, 94 through 99. I have revenues, EBITDA, EBIT. In fact, I have net income, earnings per share. I've kind of cut them off because I ran out of columns. Okay. So with each one, here's what I've computed. I've computed an arithmetic average growth rate. So everybody clear on how I do that? I just add the 5 growth rates up and divide by 5. I compute a geometric average growth rate, which actually requires us the starting number and the ending number. Right? So in this case, it's a 5-year. I take the ending number, divide by the starting number, and raise it to the power 1/5. That's what the compounding does. So I don't even need any of the middle numbers. And I've computed a standard deviation showing you how much variance there is. With every single metric, what do you notice? My geometric average is lower than my arithmetic average. But look at how much the difference widens as I go from revenues to EBITDA to EBIT. In fact, if I showed you the net income, it's even wider. The earnings per share, it's even wider. So this is actually almost a math question. Under what conditions will the arithmetic average and the geometric average give you exactly the same number? What's got to be true about the growth rates? They've got to be exactly the same growth rate. In fact, if I get 8%, 8%, 8%, 8%, 8% all 5 years, my arithmetic average growth rate will be 8, my geometric average will be 8. The greater the variance in those growth rates, the bigger the difference in arithmetic average growth rates and geometric average growth rates. You say, who cares? Which one do you think is closer to the truth? In fact, let's take EBIT, right? You started at 2.6 billion in 94. You ended with 3.2 billion in 98. Forget about all the annualized numbers. If I just take 2.6 billion and 3.2 billion, I grew at best about 20% over 5 years, right? Take a look at my arithmetic average growth rate. It's 42.45% a year. The magic of averaging. Mutual funds, until I think the 1970s, were allowed to report arithmetic average returns when they traded. And the problem with arithmetic average returns is, and I'll give you the simplest analogy, you start with, let's say, $50. In year 2, you go to $100. Year 3, you go back to $50. Let me ask you a question. If you started with $50 and ended with $50, what return did you make over the years? It's 0%, right? You basically, but through the magic of arithmetic averaging, I can convince you made a 25% return a year. Because here's what happened. 50 to 100 is 100% return. 100 back to 50 is a minus 50% return. 100 and minus 50 put together, 50 divided by 2 is 25%. You can't argue with the math. Your eyes are fooling you. It looks like you have exactly the same money, but you really made 25%. I can't even believe people use arithmetic averaging still. So as you look at growth rates for your companies, start playing with the numbers, because you're going to very quickly see why different ways, different choices lead to different conclusions. You don't have to compute them. If you want, you can use my debate as I've computed by industry. If it's close enough to apply, then just use it. It's public data. I mean, I think it's good to pick at least one business so you can get your hands dirty to see how the process plays out. But this is not a test of can you do number crunching spreadsheet, right? So in a sense, focus in on the big picture. I really want you to value the company. So for your own good, you might want to pick at least one sector and figure out how you compute a beta for that sector. But once you've done that, the other 4 you can use them. Because I assume if you can do 1, you can do 5. It's always long-term expected growth rate.
Yeah, it's on the dividends and buybacks.
Long-term expected growth rate and the dividends. There's a long-term expected growth rate?
Yeah. So it's not the risk-free rate that is like eventually going to be.
Right.
It's like the
So there are three tables. First table actually gives you dividends and buybacks as a percentage of the index. So it gives you the percentage each year, like a yield number. Second table gives you the net income and so basically I have the S&P. So basically I have all the numbers. Where do you see the growth rate? Which table?
so there's a dividends and buybacks tab, right?
Oh, there's a growth rate tab. That's
Yeah,
for the
yeah,
first
yeah.
Friday. So it's not the dividends and buybacks tab. It's the growth rate tab. Yeah. So yeah. It's a bottom up because basically anytime you take analysts for individual companies and you compute an average. So this is the growth rate from Yahoo Finance for each company, the average amount. You get a much higher number than what you would get by looking at the top-down estimate. That's why I focus in on that top-down estimate that looks at the aggregate earnings for the index.
They no longer count.
Well, S&P does in there. You have to go into the indices and click on the S&P 500 and click on the facts that there's an earnings spreadsheet you download, and it'll give you next year, the year after. No, it's actually not reported in any open space. You actually have to download the spreadsheet and give you the next year.
Downloaded it and it only had the bottom up numbers, like the bottom up estimates was like how can I walk by this?
The S&P Excel spreadsheet.
Like the most recent one.
Okay, I don't know. I'll have to check it. Maybe it'll change. Okay. Hi.
Question.
Yeah.
I know there's a bunch of people who are Jewish are going to miss the third quiz because it's during the Jewish holiday. So I'm just wondering if that's
Is it on the Jewish holiday?
yes on Passover.
Okay, I'll figure something out. If that's not fair. So.
Thank you.
Yeah.
And also the second quiz, I have one of my good friends getting married.
I'll do the third quiz, as I said. I'll see if we can do a makeover. The second quiz, unfortunately, just
So it
moved to
counts
10.
towards-
Exactly. We just moved the 10% to the third quiz of the plan.
So, and now also, I'm working with Zillow for the project. I saw your webcast for capitalizing R&D expense, and then when it came down to the income tax, there, it's all negative earnings,
So zero tax rate.
so it's just zero. So how does that? Do you
It doesn't
say-
affect any of the capitalization.